Good afternoon and welcome to today's webinar, University Retirement Plans Under Siege. I'm Tom Mitzoff and I'll be your host today. I'll be speaking with my colleague Travis Cliff, a certified financial planner here at Filbrandt Investment Advisors. We are the trusted financial resource for university professionals nationwide. Certified Financial Planner is the top certification that people in our industry can attain. Travis brings 15 years of professional experience to the table today, along with a certification. If you have any technical difficulties at any point during this webinar, please call 800-431-9740. We have people waiting to assist you. We'll be taking questions at the end of the webinar, but you may submit questions at any time. Just click the chat icon to reveal the window where you can type in your question. We have a special offer exclusively for webinar participants. We will share it with you after the webinar, so be sure to listen until the end. If you've never been to one of our webinars in the past, you may be wondering just what Filbrandt & Company is. We are an independent financial advisory firm that focuses on helping university professionals reach their financial goals. That's what truly sets us apart from any other financial firm. We know the life circumstances and needs unique to university professionals. We don't sell any financial products, so we're not incented by commissions to sway advice in one direction or another. Therefore, you can be sure that you're getting really objective advice. We're based out of Madison, Wisconsin. We assist hundreds of professors at more than 50 universities across the country who rely on the Filbrandt Advantage. And we have served university professionals for decades, so we have the experience that you're looking for. We're here to talk about looming federal legislation that could take a big bite out of your university retirement savings plans. The President's proposed 2017 federal budget includes a provision which would slam the door shut on income tax deferrals for retirement plans. What we're going to tell you today is the effect this will have on your university retirement accounts, and it could be very significant. And there's one aspect of estate planning documents that most people don't think about that might be putting your retirement savings at imminent risk. The good news, this is something you can control yourself. You don't need an attorney. Whether this law passes or not, we're going to tell you today what you need to look for and check to potentially save yourself and your heirs a boatload of money. Allow me to welcome Filbrandt & Company's Certified Financial Planner, Travis Cliff. He will tell us what this looming change means for those of you who have joined us today.
Well, thank you, Tom, and I'd like to thank everyone who has joined us today. I'll be discussing a proposed major change in the tax code that could have a direct impact on university professionals. Your retirement plans have been under siege for years, and this proposed change could have an even greater impact than those we've seen in the past. Since the 2013 fiscal cliff legislation, we've seen a number of tax changes that will have a significant impact on those of you on the webinar today. The 2017 budget proposal contains several new provisions to raise taxes, and this is on top of the sharp increases since 2013. Currently, the top marginal income tax rate is close to 40%, and capital gains tax rates now top out at around 24%, including the new net investment income surtax. Federal and state income taxes can now reach close to 50%. This is especially important to university professionals because your university retirement accounts will be subject to income taxes whether you're drawing from them or your heirs are. In the 2017 budget proposal, one item is of particular importance to those of you on the webinar today. It includes eliminating what's referred to as the stretch IRA. Now, it's unlikely that major tax changes will happen in an election year, but many tax experts believe that this proposal is inevitable.
For many people on this webinar, this change could affect their single largest retirement plan asset, right, Travis? Just what is a stretch IRA?
Well, Tom, stretch IRAs have been a valuable tool for those inheriting IRAs for really the last 15 years. Stretching of an individual retirement account refers to the practice of partially sustaining the income tax deferred status of an IRA after the death of the owner. Those of you on the webinar today may be aware that you are able to continue to defer the taxes on your retirement accounts to age 70 and a half, or possibly longer if you're still working. Well, a stretch IRA allows a beneficiary of an IRA to draw the account out in little pieces over their lifetime. So for example, a 40-year-old beneficiary can take distributions over a 43-year period. That is a significant advantage, allowing for deferral of taxes to continue for decades. These advantages can amount to hundreds of thousands of dollars for the first generation, and sometimes millions of dollars to the second generation if that stretch is sustained.
In 2012, Congress introduced a formal proposal to eliminate the stretch IRA. The President was in favor of it. The Republican House voted for it, but the Senate defeated the bill by a narrow 51-49 margin. The proposal to eliminate the stretch IRA has been in the President's proposed budget every year since then. It is again included in the 2017 fiscal budget proposal submitted by the President to Congress. Experts believe that the elimination of the stretch IRA is a question of when and not if. So, Travis, how drastic are the consequences of this change?
Well, Tom, they're pretty drastic. The proposal would eliminate the stretch IRA provision and require that all state and federal income taxes would be due within 5 years of the heir receiving the inheritance. So for our same 40-year-old beneficiary, they would be required to cash in the full IRA in 5 years instead of 43 years. Remember that these payments to the beneficiary are similar to salary, so the greater the distribution, the higher the tax rate. And these payments are added to other income that the beneficiary has, including their own salary. Now, I want to be very clear that this is not an inheritance or an estate tax. These are income taxes due on retirement plan accounts and would be in addition to any estate or inheritance taxes that could be due. Here's a graph comparing the current stretch provision versus the new proposal, where all funds would have to be distributed within 5 years. You can see the difference on a $1 million pre-tax retirement account between stretching the distributions or not could cost as much as $500,000. That's half the value of the account at death.
The recent attack on qualified retirement plan assets is particularly painful to university professionals. How will this change affect university professionals more than people in other professions?
Let's take a look. You know, a farmer generally has land, equipment, maybe livestock, buildings. These assets have special treatment under the tax code at death. They receive what's called a step-up in basis at death. And the heir, you know, the beneficiary of these assets will not owe any income or capital gains taxes if the assets are sold at death. We can look at a business owner and they're in a similar situation. They may have a plant or equipment, maybe stock in their own company, and they will also receive this favorable tax treatment at death. What separates university professionals is that most of the time a large portion of their assets are in tax-deferred retirement accounts that do not receive a step-up in basis at death. So not only does the retirement account pass to your heirs, but the taxes go with it. I met with a professor the other day that had over 90% of her net worth in pre-tax retirement accounts. This proposal to eliminate the stretch IRA would have a major impact on her and what her children would eventually receive.
For years, professors have been advised to defer using pre-tax accounts. Is this still a good idea?
Well, Tom, I think in some cases pre-tax savings can still be a very valuable tool, especially for those in higher income tax brackets. But I think the benefits of pre-tax investing are diminishing. If you consider the rising tax rate environment that we're in and the recent budget proposals, now is an excellent time to probably evaluate what's best for your situation and consider other options for saving.
There are two major mistakes that we can help the viewers who are here today avoid. Folks, they both involve the way your beneficiaries are listed in your various retirement accounts. Travis, there may be some folks on the webinar today who have My Estate listed as a beneficiary, or they may have even left that important line blank. Talk about why that could be very costly.
Well, Tom, you're right. Those two mistakes could be very costly. But first, I think it's important to appreciate that university retirement accounts and IRAs pass to heirs through beneficiary designation, not through your will. So ensuring that your beneficiaries are properly recorded is extremely important. If you leave If you leave your beneficiary blank, or let's say you write estate, your beneficiaries will lose the ability to take advantage of this stretch IRA and its benefits as we discussed previously. These mistakes could reduce the inheritance from $1 million to $500,000 just that quickly. Even if the new proposal passes to eliminate the stretch IRA, the spouse of the deceased will retain the option for a stretch IRA and be able to continue to defer the taxes on the account if they're listed as the beneficiary. I think this is an important point. So what you should do, regardless of what happens, is review your current beneficiary designations and probably list your spouse as a primary beneficiary so that your spouse can continue to defer this. It's probably appropriate to put your children down as contingent beneficiaries if that's what your goals are. I did a beneficiary audit for a professor at the University of North Carolina the other day, and we found someone listed as a beneficiary on their accounts that they didn't even know. It's very common to find mistakes when we do beneficiary audits. So I'd recommend doing a beneficiary audit today and ensuring that it fits with your overall estate plan. Understand that this is probably the primary benefit of having a financial advisor, to help you avoid making big mistakes like these ones that could cost you and your beneficiaries hundreds of thousands of dollars.